Welcome back to Geoscope, where we break down the stories shaping the world's power map. Today, a $200 billion gold standoff is unfolding. Germany and Italy are demanding the return of their bullion from the New York Federal Reserve, as Trump's renewed trade threats and tariffs rattle old alliances. For decades, European nations stored their reserves in U.S. vaults for security, but now, that trust is reversing. From Berlin to Rome, central banks are questioning whether "Made in America" still means safe and secure. This isn't just about gold bars in a vault, it's about who controls the world's wealth, and the balance of global power. The story of this $200 billion standoff begins in the ashes of World War II. As Europe rebuilt, the Bretton Woods Agreement established a new global financial order, with the US dollar pegged to gold at its center. For nations like West Germany and Italy, storing their burgeoning gold reserves in the subterranean vaults of the New York Federal Reserve was a matter of pure logic. It was the most secure and liquid financial center on Earth. Then came the Cold War, which turned this financial logic into a strategic necessity. For West Germany, a frontline state facing the constant threat of a Soviet invasion, keeping its national treasure 4,000 miles away, safe behind the Atlantic, was the ultimate insurance policy. If Soviet tanks ever rolled across the Fulda Gap, the nation's wealth would be beyond their reach, preserving the foundation of its sovereignty. This legacy arrangement persists today. Germany, the world's second-largest holder of gold after the United States, still entrusts over 1,200 metric tons, more than a third of its entire reserve, to that vault beneath Manhattan. Italy, the world's fourth-largest holder, keeps a staggering 43% of its gold there. Combined, it's a hoard of nearly 2,400 tons, with a market value approaching $200 billion. For decades, this was an unquestioned symbol of transatlantic trust, a financial bedrock built on the shared values of the post-war era. But the foundation of that trust is now cracking, largely under the shadow of a potential Donald Trump presidency. His past attacks on the independence of the Federal Reserve, the very institution acting as custodian, have sent shockwaves across the Atlantic. Central bank independence is a sacred principle, ensuring monetary policy is free from political whim. Trump's rhetoric shatters that principle. For European leaders, the question is stark. If a U.S. president is willing to pressure his own country's most vital financial institution, what would stop him from using foreign-owned assets as a bargaining chip in a political dispute? This anxiety is echoing loudly through the halls of power in Berlin. Germany's influential Taxpayers' Federation has issued stark warnings that a Trump administration could directly jeopardize the security of the nation's offshore gold. Markus Ferber, a prominent Christian Democratic Union politician, has been even more blunt, stating that America is simply no longer the reliable partner it once was. The sentiment is clear. The dependable ally of the Cold War has been replaced by an unpredictable, transactional partner, making the old security calculus obsolete. Consequently, a debate once confined to the fringes of Eurosceptic parties and conspiracy blogs has exploded into the mainstream. Germany's public broadcasters, ZDF and ARD, institutions akin to the BBC, are now dedicating primetime coverage to the issue. They are asking pointed questions that officials can no longer ignore. Why does the Cold War rationale of the 1950s still apply in the turbulent geopolitics of the 2020s? Why is so much of the nation's wealth stored in a country whose political stability is now a source of international concern? Caught in the crossfire is Germany's central bank, the Bundesbank. It insists the gold is safe, pointing to regular audits and the unwavering integrity of the Fed. However, these audits are shockingly limited, with German officials only ever inspecting a small fraction of the bars. The bank's assurances are further undermined by its own past actions. Between 2013 and 2017, it undertook a monumental effort to repatriate 300 tons from New York. The operation was a success, but it was halted prematurely. Now, that decision looks dangerously complacent. The Bundesbank claims it's ready to act if risks escalate, but the logistical nightmare of securely moving over 1,000 tons of gold across the Atlantic would take years, not days. This German anxiety is not happening in a vacuum. It's part of a seismic global shift. Central banks from Poland to Hungary to the Netherlands have already been bringing their gold home. The weaponization of the financial system, particularly the freezing of Russia's offshore reserves in 2022, served as a global wake-up call. It proved that assets held abroad are not untouchable political leverage. The latest surveys confirm the trend. An overwhelming 95% of central banks expect to increase their gold reserves, while a record 59% are actively increasing the amount stored within their own borders. The age of unconditional trust in offshore vaults is over. In Germany, gold repatriation has moved from a niche issue to a political flashpoint. The far-right AfD has long linked gold to sovereignty, but now even left-wing politicians are on board. Italy faces similar divisions. Prime Minister Giorgia Meloni once promised to bring gold home, but in power, she's balancing nationalist rhetoric with U.S. diplomacy. Critics warn that leaving nearly half of Italy's gold in America, under Trump, is a gamble. In Berlin, mainstream conservatives now see gold as leverage in trade talks, especially over steel and autos. Calls for parliamentary hearings are growing. The political consensus is shifting fast. Repatriating 1,930 tons of gold isn't symbolic. It's a massive logistical mission of historic proportions. This isn't a wire transfer. It's the physical relocation of a national treasure worth nearly $250 billion. We're talking about over 150,000 individual gold bars, with a combined weight equivalent to 4 Airbus A380s, moved across the Atlantic. Every ounce must be meticulously tracked and secured, as the slightest error could trigger a crisis. Germany has done it before. From 2013-2017, the Bundesbank moved 674 tons from New York and Paris, using NATO aircraft and tight military security. That operation, completed years ahead of schedule, was a masterclass in precision. It served as a crucial test, and its lessons are now being scaled up for a mission almost 3 times larger, where the financial and political stakes are exponentially higher. This time, Germany and Italy are looking at their combined $245 billion worth of bullion. The plan involves flying it from New York to Frankfurt and Rome in alternating 50-ton weekly shipments. But this isn't a quick affair. Moving the full 1,930 tons would be a relentless 10-month-long operation. Each flight would be a self-contained, multi-billion-dollar mission requiring unwavering focus. The security would be extraordinary. NATO oversight, military escorts, secure air corridors, the works. Fighter jets would flank cargo planes across the Atlantic, while elite special forces secure every inch of the route on the ground. From the armored convoys in Manhattan to the final delivery in Europe, the entire chain would be under microscopic surveillance. It's a zero-fail mission. But first, political clearance is needed. The Bundesbank calls New York's vault trustworthy but is tightening audit protocols, a clear sign of diplomatic hedging. Italy would need cabinet approval, budgets, diplomatic sign-off, and military coordination. These aren't simple formalities, they are complex negotiations at the highest levels of government where the entire operation could stall before it even begins. A visible gold airlift could strain US-EU relations, or signal a vote of no confidence in America's financial stewardship. It would be interpreted globally as a profound statement on the US dollar's stability, potentially sending shockwaves through the financial system. What begins as a logistical challenge could quickly escalate, signaling a tectonic shift in trust and power on the world stage. Pulling over $200 billion of gold from US vaults would be far more than symbolic. It would be a financial earthquake. The immediate shockwave would hit liquidity, the essential lubricant of the financial system. A sudden withdrawal of this magnitude would be like draining oil from a running engine. Key short-term lending markets, like the repo market where banks lend to each other overnight, could freeze. This would instantly spike borrowing rates, creating a credit crunch that ripples outwards. More than just a technical problem, it's a devastating blow to investor confidence, the very bedrock of market stability. This panic would quickly infect the bond market. As U.S. Treasury bonds, long seen as the world's safest asset, suddenly appear riskier, investors would demand higher returns. This means Treasury yields would spike. Because these yields are the benchmark for nearly every other interest rate, the pain would spread to Main Street. Mortgage rates would climb, pricing families out of the housing market. Car loans, credit card APRs, and business loans would all become more expensive. This isn't a Wall Street problem. It's a direct squeeze on household budgets and a barrier to economic growth. Now consider the domino effect. To fund this massive gold repatriation, Germany and Italy would likely sell off their vast holdings of U.S. Treasury bonds. This floods the market with supply, causing bond prices to fall and yields to soar even higher. This creates a vicious cycle for the US government, which is already managing a colossal national debt. Washington constantly needs to sell new bonds to fund everything from defense to infrastructure. If major creditors become major sellers, who will buy that new debt? The answer is, only at much higher, more painful interest rates, making it harder to fund the nation's future. This move doesn't happen in isolation. It's part of a deliberate global trend of de-dollarization. Central banks in China, India, Turkey, and beyond are aggressively buying gold to diversify away from the dollar. They're hedging against US inflation and insulating themselves from sanctions. Gold is a neutral sovereign asset no single nation controls. Today, gold makes up over 20% of global reserves, double its share from 2000. If this trend accelerates, that could hit 25% by 2028, representing hundreds of billions in lost demand for US debt and a direct challenge to the dollar's supremacy. The final result is the dawn of a new, more expensive era for America. The exorbitant privilege of issuing the world's reserve currency, which allowed the US to borrow cheaply for decades, is eroding. This means persistently higher interest rates, costlier credit for consumers and businesses, and agonizing choices for Washington. How do you fund a government with spiraling borrowing costs? The options are grim: deep spending cuts or major tax hikes. With nearly half of central banks planning to buy more gold, the trend is undeniable. The dollar's safe haven status is slipping, signaling a fundamental reordering of global power. Germany and Italy's move is more than a transfer of gold. It's a signal that old trust in US financial leadership is cracking, with both short-term market jolts and long-term geopolitical consequences. This could mark the beginning of a gold-fueled realignment of global power. Do you think other nations will follow? And is gold truly reclaiming its role at the center of global finance? Or is this just political theater? Share your thoughts below. And stay tuned to Geoscope for more stories that map the power shifts reshaping our world.